So, if you're joining us today, chances are you're looking for some great strategic information. And our presenter today is exactly the person that you want to get that from. He's someone who has spent more than 35 years helping families protect and grow their wealth with smart, tax savvy planning. He is a CPA, an attorney, and a nationally recognized expert on Roth IRA conversions, retirement plan distributions, and holistic tax, estate, and gifting strategies. He's a prolific writer, and his strategies have been featured in the Wall Street Journal over 36 times. And he has authored 10 best-selling financial books, including Retire Secure, The Roth Revolution, and of course, Retire Secure for professors and TIAA participants. So I'm going to go ahead and turn things over to Jim. Join me in welcoming Jim.
Thank you, Erica. So let's start with the problem. The problem is a crippling taxation of your IRAs and your traditional retirement plans after retirement that cuts dramatically into how much money you can spend. And the next problem is what happens after you die. If you have a substantial IRA, 401k, 403b, you have this decimating a tax acceleration of your IRAs and retirement plans that has happened since 2000, where before your heirs used to be able to defer or stretch the inherited IRA over their lifetime, and now, subject to exception, they have to take all that money out in 10 years. And if you have to pay income tax on $1 million or anywhere near that amount, the tax on that is just devastating. And it's even worse if the only money you have to pay the tax is money that you haven't paid tax on. So we have these two enormous problems for people who have particularly portfolios that are, let's say, concentrated in IRAs. When I say IRAs, I also refer to 401ks, 403bs, SEP, KIOs, what I'll call pre-tax dollars. So let's start with the solution. So it's not a big surprise, but we'll obviously get into a lot of detail. And the solution is a series of strategically planned Roth IRA or potentially Roth 401k conversions. It's not going to be for everybody, but it's going to be for a lot of people, and it will likely make a huge difference in your family's long-term financial future. I will also say it is potentially one of the most important action points that you can take. We really don't have control over the market. So you can do what you will with the market, but the truth is it's kind of a crapshoot. You heard Bert, maybe you did or maybe you didn't, and Bert Malkiel was saying, hey, I understand about all the things that he, who, by the way, is a classic Republican, railed against, like the tariffs and the Federal Reserve, in effect, takeover, the immigration and the detention and all these things that he personally abhors, but he's still saying, stay in the market. So I'm not here to give investment advice on this webinar, but let's just say that whether you do or whether you don't, it's a little bit of a crapshoot, particularly if you don't. But the Roth IRA conversions is going to be math. And in the vast majority of cases, you and your family can be much, much better off in terms of purchasing power and long-term generational wealth. Because we can't control the market, but we can control our Roth IRA conversion, or frankly, lack of Roth IRA conversion. So I am a big believer in peer review. So, for example, if you're a doctor and you have a new idea for a medicine or a treatment or something like that, and you want to prove to the world that your idea is wonderful, you go to a peer-reviewed journal like the New England Journal of Medicine, you submit it, you submit your research, you submit, the studies that you did, et cetera, et cetera, et cetera. And then you have a bunch of other doctors who read it and they're trying to nitpick it apart. And if it passes muster, then they publish it in the New England Journal of Medicine or maybe Nature, some other magazine, and people can rely on that much more than if it's published by Joe Schmo Publishing, or it's not even published at all. It comes to you as an email. I'm a big believer in that. And they have the same thing in the tax world. It's called the tax advisor, and you submit your article and you put in your spreadsheets and you put in how you backed everything up, et cetera, et cetera, et cetera. And if it passes muster, they will ultimately publish it. And they did for me, and it was the tax advisor published the first article on Roth IRAs and Roth IRA conversions that I wrote. I finished writing it in 97 before it was even law because I knew it was going to be such a big deal. They published it in 98. And the same concept, certainly there have been plenty of changes since then, but the same concepts that we used to do the math in 1997 that was published in 98 are still applicable today. Now we've updated the taxes, et cetera, but you will learn those peer-reviewed concepts that have got the okay from these nitpicking CPAs who just want to tear me apart, as along with everybody else. You'll learn something that we call the secret. For some of you, it's not so secret because I've been talking about it for 20 years. More than 20, well, let's see. Yeah, more than 20 years, 25 years or 27 years. So it's not new, but it's new to many people. And I actually think it's one of the most important foundational pieces of information and concepts that you can have for Roth IRA conversions, or for that matter, even if you don't have a Roth IRA. The secret is incredibly important. We're going to talk about some advanced Roth concepts. We're not going to spend a lot of time on the details of the OBBBA, which is the new tax law. But I'll give you the summary of the most important things. And by the way, Jen Hall, who's going to be joining us, she's the one who kind of gets in the weeds, and she would be able to tell you, the nuances of some of the details of the Tax Cut and Jobs Act of 2017, which is what the OBBA in effect extended. Because in 2017, the Tax Cut and Jobs Act was set to sunset or expire at the end of this year. So what we expected was, okay, it's 2017, taxes are up here. Then there was a big tax cut, and that continued until, presumably January 1, 2016, in which case the rates were going to go back up here. And then what did the OBBBA do? It said, no, we're going to extend those low income tax rates. So that's great news for people who have big IRAs, people who are at a higher tax bracket, people who we now can extend the period of doing additional Roth IRA conversions at lower rates. So as much as you may or may not like it for the politics of the country, and particularly some of the provisions, that we're talking about now, in Medicaid and insurance, et cetera. But for people who, let's say, if you're voting your pocketbook, or you're supporting your pocketbook, this is most likely a very good thing for you and your family. And we'll talk about how to take advantage of that. But what the thing I'm going to be concentrating on is this gives us a great opportunity to make Roth IRA conversions. So older and wealthier IRA owners will benefit enormously from the OBBBA. Okay. By the way, it is a complicated mess. I'm going to be just kind of talking at the cloud level, but it's Jen and the other CPAs in my office who have to actually dig in the details. And without exception, all the CPAs in my office, they hate it because it's much more complicated, and planning becomes more time consuming, more complicated. You have to run more scenarios. There's more what ifs. And people say, oh, I'll bet you love when they change the tax law because that, really encourages more. No, no, no. We have a lot of business. We would be happy if they just picked the tax code, said, here it is, and we're not going to change it for a long time. That would make our lives so much easier, but that's not the case. And Jen hates it. All the CPAs hate it because it is much more difficult to plan. And the worst is if you're planning for Roth IRA conversions, because, and again, for do-it-yourselfers, this is really kind of a nightmare if you're really going to do it right, which obviously we do. Okay, so let's get into the essence of a Roth IRA conversion. And what you're doing is you're taking a traditional IRA, 401k, 403b, SEP, KEO, etc., but money that is what we call pre-tax. Nobody has yet paid income taxes on it. It might have come from you, it might have come from your employer, or more likely, maybe some of each. And you take that money that normally, when withdrawn, including the growth, would all be taxable, and you're transferring that to a tax-free vehicle called a Roth IRA. And this process to do that is called a Roth IRA conversion, or a conversion to a Roth IRA. So the bad news is you have to pay the income taxes up front right now, this year, no extensions, none of that 4-year stuff that they used to have. You have to pay the tax on that, in the tax year, or maybe you file after year end. Well, obviously you file after year end, and depending on estimates, et cetera, you're either paying at the year of the conversion or maybe a couple months after that. But you are having a tax hit when you convert your traditional IRA to a Roth IRA. And of course, the Roth IRA grows income tax free, which is the whole benefit of it. So basically, instead of pay taxes later, which was the old mantra, now it's pay taxes later except the Roth, because the tax-free growth that you receive after you make the conversion, when you run the numbers, and we're going to show you that, is going to be more valuable than the money that you paid up front to pay the taxes on the conversion, including the opportunity costs or the money that you would have received had you not made the conversion and had invested the money that you are now giving to the IRS. And we're going to get into a little bit of nitty-gritty math. The other bonus is that there's no required minimum distribution for either you or your spouse on this Roth IRA conversion or a Roth IRA. So that's really big, because that will allow you to keep that Roth IRA intact, continue to grow it during your lifetime, and just watch it grow income tax free year after year after year. They did an article on, with this with this, let's say, method of doing Roth IRA conversions, and they show me on a bicycle and having fun, and Jim's riding his bike while his Roth IRA grows income tax free. And by the way, we'll get into this a little bit, but our family will be well over $1 million better off, even in today's dollars, because of the Roth IRA conversions that I made. There is a required minimum distribution for inherited IRAs and inherited Roth IRAs. All that money has to come out depending on when you died for an IRA, either during the first 10 years or at the 10th, I guess the year after the anniversary of the 10th anniversary of your death. For inherited Roth IRAs, that money can sit there and continue to grow income tax free for 10 years, even after you die. Okay, so what is the secret? And again, I've taught this to thousands of people. And the people who kind of get it the best intuitively, they tend to be the CPAs. Probably the next set of people who get it the next best are people that have some quantitative background. The people who are not quite as good as them, but they're not so bad, are the financial advisors. The people that have the hardest time with this are the attorneys. And I'm an attorney, so I'm allowed to knock other attorneys. But when you do workshops that involve math or taxes and your audience are attorneys, which I've been in front of for years, you have to kind of dumb it down a little bit, maybe a lot. And it's what some of the attorneys don't know, even about estate planning and wills and trusts, I just kind of couldn't believe it. But anyway, the secret is to measure wealth in purchasing power. So what does that mean? So let's say that you have $1 million in your IRA. And let's say your next door neighbor has $800,000, but it's not in an IRA, it's in a plain old brokerage account. And let's forget about the capital gains or the appreciation. Let's just call it plain old after-tax dollars. So you have more money than your neighbor because you have $1 million, your neighbor has 800,000. But I don't think that total dollars are a good measurement tool to measure wealth. I want to measure in purchasing power. So let's say you wanted to go out and buy something and you had $1 million in an IRA. And of course, you would never do this, but let's just say you cashed in your entire IRA. And let's just, to keep it simple, say that the tax on it was 400,000. So after you're done paying taxes, you only have $600,000 left. But your neighbor, who had $800,000, but he doesn't have to pay any taxes, he has 800,000, you have 600,000. So even though you have more money than he does, he has more purchasing power than you. So is everybody okay with measuring wealth in purchasing power instead of total dollars? All right. That is a critical concept. And if you don't get that right, you're going to come up with bad analysis for Roth IRA conversions. And most of the computer programs that I see, the AI stuff, and even a lot of the financial advisors that we see don't get this right. In fact, I'm even going to take a minute and say, are there any questions on this up to this point? Because I really want you on board with measuring and purchasing power, which is how much money you can go out and buy goods and services for after you cash it in and pay the taxes. So do we have any questions on that, Erica, before I even move on?
We do have questions, not so much on purchasing power so far. And by the way, if you have questions on this specific topic, I encourage you to add them right this second to the chat. I might ask it right now. But we do have some questions about Roth conversions, TCJA, long-term planning. Would you like to take those now or hold off?
No, why don't we take two of them right now?
Okay, great. So Bill asks a kind of complicated question, but I think it's actually a good one to suss out here. It's not just specific to him, I don't think. So he said, due to the impending end of the TCJA at the end of 2025, I did large Roth conversions in 23 and 24, resulting in large IRMAA premiums for 25 and 26. Now that the tax cuts are permanent, for now anyway, I want to reduce my Roth conversions over the next few years, but I also to be aware of Social Security kicking in when I reach age 70, as well as RMDs at 73. I'm currently 67. Any advice?
Well, sure, I can figure out exactly off the top of my head exactly how much he should convert, exactly how much he should spend. No, but this is what I will say, and I'll limit the answer to Roth IRA conversion. That is a classic case of running the numbers, and there's nothing magical about it. Obviously, we have wonderful tools, and we also have razor sharp CPAs who do that work. So to do that work around here, you need to start with a veteran CPA who's been doing tax returns at least 6 or 7 years. Then you have to go through a training period, which is probably going to last at least 2 years. And then you're just like at the beginning of the ability to do what we consider serious number crunching, and that would be a way to do it. And I'd like to say, oh yeah, we use this new wild AI program, and all you have to do is put in a couple numbers and hit maximize, and poof, out it comes. We're nowhere near that. In fact, of course, we're looking at, you know, the software that comes around. We're not happy with really any method that we know of except ours. And one of the advantages of our method is we know where every single number came from. We use a combination of, believe it or not, good old-fashioned Excel for some things. We use Brent Marks software, which is for typically financial professionals, and we really like that. And it's really kind of like the accountants type software because you can trace where every single number comes from, as opposed to some of the other types of software where you don't know how they got the number. And believe it or not, we actually do pro forma 1040s. So we actually plug in your 1040, and then we test. Well, what if you do 20,000? What if you do 40,000? What if you do 60,000, et cetera, et cetera. And it's more of a manual process than you would expect. And the quantitative folks love it. They could spend all day. In fact, they say, would you mind doing 36 scenarios that I've been thinking of? But anyway, the short answer is I could never do something like that off the top of my head. What I will tell you is one of the reasons I hate having inconsistent tax law is because people, in reliance on what they think the tax law is going to do things. So the fact that you did higher than average Roth IRA conversions, which is going to put you in a higher tax bracket for income tax purposes, it's going to kick up, or apparently already did kick up, your Medicare Part B. It's a shame, but that's the world that we're living in. And I'm not sure it's going to change because over my long career, I've seen a lot of taxes go up and down, and it makes a big difference. So I'll give you the huge difference was in 2020 when they did the Secure Act. That changed estate planning, that changed Roth planning, that changed disclaimers. And frankly, I hated it. And the other thing is, I think it kind of screwed people because people acted on reliance of what the tax law was. And then, sometimes for a lot of people late in the game, they say, hey, guess what? We're going to change the rules. And that's kind of what happened to you, to the person asking the question. All right, why don't we take one more and then we'll move on?
Great. Um, we did have a question that I think you might be able to put into context. Maybe not though. When I was when I was asking if anyone had any questions about uh, the spending power, I think it was, or was it
Purchase power, go ahead.
purchasing power? Yes. Linda asked, but the neighbor has to pay capital gains tax, right? So were you doing a comparison between one person who did things one way and another?
Well, in that simple example, I was assuming that there was no capital gains. I was assuming that the 800,000 had an $800,000 basis. But by the way, even if it had a zero um, basis and there were capital gains on it, the capital gains would have been at most well, not necessarily at most, but let's say it might have been at 20%. All right. So even then, let's see, so that'd be 600. So that if that would be 640, and depending on how much tax the other person paid on the million, maybe the 800,000. And by the way, it's not all going to be capital gain. There's always some basis. So and that was likely done. The question likely came from an engineer who always wants to nitpick me, and that's fair enough. But by the way, and I tend to be more big picture, but the CPAs who do the work, they love that stuff, and they'll talk till you're blue in the face, till they're blue in the face, and I won't even say you can't stand it because a lot of the quantitative folks, they love these sessions. And in fact, the CPAs sometimes have a problem saying, okay, enough is enough. We've been here for hours and hours. We're just going to call it. All right. So you have an idea of purchasing power. why don't we go back to measuring wealth in total dollars? All right. So let's assume that we both have $100,000. And by the way, same concept if it was $1 million, but I have 100,000 in my IRA. I have $24,000 outside my IRA. All right. You have the exact same amount. You have 100,000 in your IRA. You have 24,000 outside the IRA. So we each have $124,000 total. And let's say I don't do anything. I'm just sitting on my butt. I have $124,000 total. You on the other hand, so by the way, how much purchasing power do I have? Well, I have $124,000 total, but if I cash in my IRA, assuming a 24% tax bracket, I really only have $100,000 in purchasing power. You, starting with the same amount, you decide to convert your $100,000 IRA to a Roth IRA. And let's say you have the money wherever you have it, and you do the conversion, you fill out the paperwork. And let's say it's at Schwab or somewhere, and they send you a 1099. It says, please add $100,000 to your income. You do so, and you get it. And the tax on that is, let's say, $24,000. So even though they have less money, because you have $124,000, they have $100,000, it's a tie in purchasing power, as you can see on this screen. So this by itself is a profound concept, which is if you measure in purchasing power, you break even, assuming a flat income tax rate, you break even on day one. All right. Not many people get this. If you get this, you're ahead of most financial advisors. All right. And the reason is because if you measure in total dollars, what will happen is you will conclude that it will take a long time for the total dollars for the person who made the Roth IRA conversion to equal or exceed the total of the person who didn't make the Roth conversion. But if you measure in purchasing power, and again, keeping it simple with a consistent tax rate, you break even on day one, which means a lot of the advice that's coming out from people who don't really get it is they're saying Roth IRA conversions are no good for older people because older people don't have enough years to live to break even on the Roth conversion. And that might be true if you were, let's say, measuring in total dollars, but if you measure in purchasing power, which is what I think is the relevant relevant measurement tool, then you break even on day one. Critical concept. So, and you get different conclusions. And by the way, there's a lot of crappy literature out there. There's a lot of crappy software out there because these people don't get it. And you have these guys, I hate to say it, but you have these non-expert writers of even some pretty respectable journals who are given the assignment, hey, do an article on Roth IRAs, and out comes crap. It's not good. It's not good. There are some superstar financial authors. Unfortunately, the two best that I know, one is retired, Jane Bryan Quinn, and the other one just died, who Jonathan Clemens of the Wall Street Journal. And he and I did 36 columns together. He got it right. He understood that very well. But anyway, if you measure in purchasing power, Roth IRA conversions might be great for older folks. In fact, most of our clients are older, and most of them are at some point working with us are doing Roth IRA conversions. And so many of the software and the AI solutions, they do more harm than good because they use the wrong measurement tool. And by the way, speaking of AI, by the way, I kind of like AI. I use it for a lot of purposes. And I use it both personally and professionally, but I've never even come close to seeing a program, AI or otherwise, that makes it easy to do Roth IRA conversions and to optimize the analysis. So there's and maybe they will come out with something someday that really makes sense. And there's some people to claim that they have something that makes sense now. And very frankly, one guy, and I'm not going to mention his name or his software, I was hoping it was going to be good because I had respect for him. And then when we got in the weeds, not so good. In fact, we not only couldn't find the flow, so let's call it work papers. We came up when we couldn't reproduce the results. So what happens is you just don't trust anything that it comes out. The good thing about our analysis is, yeah, you could challenge our assumptions, and maybe the assumptions we use don't hold water, but you could see where we got everything that we are recommending. And again, we're constantly looking, but we're using, and by the way, when I started doing this in 98, we were using Excel. They didn't have any of the stuff that they have now, like Brentmark and some of the other software tools that just make life so much easier. And interestingly enough, we still are old-fashioned enough. We still, for certain calculations, we use Excel. And guess what else we use? Plain old 1040 software. So sometimes we will check a result and actually do, in effect, a pro forma 1040, testing different levels of conversion. And sometimes we get surprises. So kind of old fashioned, but it gives us a lot of assurance if we can, let's say, prove a conclusion that we arrived at one way and prove by looking at it a different way. Again, we're CPAs, and by the way, we have a really good team and rock solid, and we're old fashioned. We want to see the work papers. How did you get that number? I don't trust the number if I don't understand how they got it. And there's nobody that I know of that to me has enough credentials that I'm going to trust how they got something without showing me how they got it. And again, we use a bunch of advanced software ourselves. We use 1040 software, but we know where the numbers are coming from. And here's the other thing, and it might even sound a little arrogant, which is certainly something I don't mean to do. This is not a matter of opinion. I like Whitney Houston. Maybe you like Barbara Streisand. And we can have a reasonable difference of opinion, and there is no right or wrong answer. Maybe somebody sold more albums, somebody was in more movies, somebody's still alive, somebody isn't. But there's no objective, okay, I can objectively prove that Whitney Houston is a better singer than Barbara Streisand. It's a matter of opinion, all right? Roth conversions are not a matter of opinion, they're a matter of math. Oh, and by the way, I have a reputation, and we can't control our reputation. And people say, oh, yeah, if you go to Jim Lange firm, they're going to run the numbers, and they're probably going to tell you to do a Roth conversion. They love Roth conversions. That's not true. Well, we do like Roth conversions for people that it really helps. But what we're going to do is we're going to run the numbers. And then based on the analysis that we do of running the numbers, then we're going to make the Roth IRA conversion recommendation. And sometimes that recommendation is don't do any more Roth IRA conversions. So, but it's a matter of math. And as long as you're using purchasing power, and yes, we could argue about the assumptions, you use 6%, you use 4%, whatever the assumptions are, you think taxes are going to go up, like that guy who just ran the numbers and he did a big conversions thinking the taxes are going to go up, and then they did. So you could argue about the assumptions, but ultimately it is a math problem, all right? And again, you have to measure in purchasing power. And we see all kinds of mistakes in this area. One, probably the biggest mistake, is IRA and retirement plan owners doing nothing. I can't tell you how many people come in at a certain point in their career, or more likely in their retirement, and I see the hundreds of thousands of dollars that were left on the table because they didn't do Roth IRA conversions when it was optimal to do it. And I asked them about it, and a lot of them, interestingly enough, did have financial advisors that they were paying good money to, sometimes 1% of their portfolio, and they deserved having good advice, or at least having the advisor say, I'm not competent to do those calculations, see somebody that is. But instead, the arrogant advisor says, I don't think it's right for you. And they were wrong. And they can't prove that they were right with math. I can. And our team can because it's math. I guess I'm getting a little bit worked up because it bothers me because a lot of these people could be in such better shape and their families could be in such better shape if they had got the right advice first and got the right advice early. A lot of times people are using this, they save the money for buying a decent program. But to be fair, the decent programs tend to have a long learning curve. But they using free or low cost software that uses total dollars instead of purchasing power. And I would say that might be worse than nothing because it might indicate they shouldn't be doing a conversion when in fact they should. Where if they didn't use the software, they wouldn't know, and maybe they would go to find somebody who actually did know. Or they guess, or they go, well, I'll use a rule of thumb. I'm going to go to the top of the 24% bracket, blah, blah. Well, I'm not going to say you're always going to be wrong, but you're certainly not going to optimize. And there's a lot more to it than thinking, oh, there's a simple, easy way to do it, which is why it takes even the most skilled CPAs hours and hours to do a long-term plan. And then the other thing is listening to quote experts who really they're not experts. They're really not qualified to make a Roth IRA conversion recommendation. And I think it is morally critical to, like Clint Eastwood says, a man's got to know his limitations. So if somebody says, gee, I have, and they might say, something that I don't know anything about. And the best thing I can do is say, I just don't know anything about that. And maybe it's something that I can research, or maybe it doesn't make sense for our firm to do the time to do, let's say, specialized research. I got this money because I work for the United Nations and it's not taxable here, but it's taxable there. And And should you do a Roth IRA conversion if you're going to go move to Canada or whatever that might be? So the best thing that an honest service provider would say is, I don't know, and I may or may not be the best fit for you. Okay. We are not a good firm if you are an expatriate. By the way, most countries don't recognize Roth conversions. So a lot of times it doesn't make sense, but that's frankly beyond our area of expertise. But if the expert that you are listening to didn't run the numbers using purchasing power as a measurement tool, that's not a good situation, and you could end up with worse than nothing advice. And then here's the one I get. Yeah, Jemiah, I get that it's math, but my situation is different. Oh, so math doesn't apply to your situation? We should use, I don't know, inspiration from the gods or from something else or a gut instinct or, oh no, see, my situation is different because of, and then they tell me their situation. And I said, well, that can be worked into a mathematical formula. Okay, you're going to get this big hit later on. Well, we can put that in. That becomes part of the assumptions, and that becomes part of the math. Or, okay, I have a reduced life expectancy, or I have a reduced life expectancy, but my spouse is going to live a long time, or whatever the situation is. A lot of times people think because their situation isn't terribly common that we can't accommodate the math, and that's just not true. We can accommodate the math, and don't think that your situation is beyond math because either it isn't, and if you're not willing to accept it, we're not a good firm to work with because we believe in running the numbers, we believe in peer review, we believe in science, kind of old-fashioned like that. But it is math. Again, you could argue about the assumptions. You can say, well, the law is going to be this, the law is going to be that, blah, blah, blah. But it's math, and it's not easy math either. It's not you just put in a bunch of numbers and hit optimize. Maybe someday they'll have that. I will just tell you that we're nowhere near that right now. And we look at everything, all the software. Okay, so if you have a situation, you just change the assumptions. And the other thing is Roth IRA conversions are likely the lowest hanging fruit for you and your family's Social Security. And I mentioned earlier, it is something that you have control over, unlike, say, the market where you don't have control. Methodology that we use to do the conversions is basically, yeah, we have better software, we have a lot more tools at our disposal, but this idea of measuring and purchasing power and doing the math, that's the same thing that we were doing back in 1998. One of the main differences, by the way, tax rates were higher back then, which meant that you got an even bigger bang for your buck for a Roth IRA conversion. And the other thing back then is they didn't have all the software that we did. So we were able to do it with Excel. And then what happens is when you're kind of doing it, which is, it's not really manual, but it's much more manual than some of the other software. When you do it manually, you understand it. So for example, when the Secure Act came in, I was almost instantly a expert for inheriting money with an IRA for children of a disability that have a disability because I understood the old rules, which were identical to the rules now for if somebody has a disability and inherits an IRA. So right from immediately, I was able to, quote, be an expert in something that I didn't spend a lot of time studying individually. By the way, then I did. And then, we went to town, partly because I have a child with a disability. I figured it out for our daughter. And we're not going to really cover that today, but I do have a book that I don't have. Oh, yeah, I do have it with me. And if anybody does have a child with a disability, I would be happy. I would want to send you this book. It has two wonderful co-authors. I humbly believe that that is the best source of financial information for a parent with a child with a disability. But anyway, math, not opinion. Let's run the numbers. Series of Roth IRA conversions. All right. And we're going to compare that to not making a series of Roth IRA conversions. So well, to be honest, I like doing saving a lot of money for a family. So we did kind of the optimal time, which is between retirement and age 73. We just got a request for a consultation. He says, I know what Jim says. He says, when you're working, your income tax bracket's up here. After you retire, it's down here. And then you have minimum required distributions and Social Security, and it goes back up here. Do your Roth IRA conversions down here. And this is where I am. And he's right. So anyway, this example, which may or may not, well, it's probably not typical. It's, let's say, lean towards the bigger difference. But we did it after retirement and before Social Security and minimum required distributions. And we measured in inflation adjusted dollars. It's more fun to use total dollars because you get this huge, huge benefit, but that's not really what, oh, you're going to be $2 million better off. Well, in today's dollars, it's 400,000. I want to hear what the benefit is in today's dollars because that's what we get. But anyway, just for you and your spouse, forget your heirs. Just doing what we had said, you're better off by $175,000. I'm sorry. That is the amount that you're converting. You're better off by $266,000 in your lifetime, and that's starting at age 65. Okay, that's a lot. How hard did you have to work to come up with $266,000 after taxes. Probably pretty hard and probably for a long time compared to just having somebody like us run the numbers and then taking action on it. That is huge. But I said earlier, most people don't even spend their Roth because if you follow what I said earlier, I usually say that's the last dollars that you're going to want to spend. So let's take a look at what the impact is if you do a series of Roth conversions versus if you don't. And we are not only taking the money that we are paying taxes into account, but we're taking the opportunity of the interest that we are losing or dividends and growth on the money that we spent on taxes that we wouldn't have spent on taxes if we didn't make a Roth IRA conversion. And now we are, in today's dollars, millions of dollars better off than if you hadn't done any conversion at all. Okay? That is huge. That is huge. And very frankly, I'm a little bit worried about the financial future of our country and my daughter and your children. And if we can protect money and have them be $2 million better off in today's dollars. Now, to be fair, that's over their lifetime. That's not the day that you die. That is a great way to help protect your family. Okay. Actually, before I go on, why don't I take a few questions, and then we will go on to a new topic.
Sounds good. We have a few questions from the first section. People asking, I'm going to lump them together, but it's because people are asking a broad question that's kind of similar, which is, how do I pay, or if I want to pay taxes on a Roth conversion from this, or should I pay it with these funds? So Brian asked, when does a HELOC make sense to pay taxes on Roth conversions? And Sundar asked, how do we calculate additional income tax from capital gains and IRMAA? How do we calculate that impact if you're selling investments to pay for a Roth conversion?
Okay, two different questions. First question, and the person who asked the question, should I pay the taxes by taking out a home equity loan? Interestingly enough, I happen to have done an article in 2019 for Forbes.com, where I am a paid columnist. And the name of the article was Let Your House Pay for Your Roth IRA Conversion. It got 300,000 hits. And the idea of it was, if you are in one of those situations, like a lot of our clients, where you have a big IRA, but you don't have a lot of money of after-tax dollars, which is my normal pool of money that I like to use to pay the tax on the Roth conversion. But let's just say, for discussion's sake, that you retired, you have $2 million in an IRA, you have not yet taken Social Security, you haven't taken your minimum required distribution, so you're in that ideal time to do a Roth conversion, but you don't have any after-tax dollars to pay the tax. Should you consider taking out a home equity loan or a HELOC and using that money to pay the tax on the conversion? And that was the whole point of the article. I will, let's say, concede that in 2019, the interest rates were lower, so it was even more attractive than doing it today. But even doing it today, we have plenty of examples, even with the current interest rates, that makes sense. I'm not going to say it makes sense for everybody, but there's a very good chance it does make sense. And the way to do that is to, quote, run the numbers. The second question, hey, Jim, okay, so I have to take into consideration the capital gains on the money that I have to sell the investments to pay the taxes on the conversion. Interestingly enough, we've run that analysis too, and I don't want to say it applies in every situation, but what we have found much more often than we have not is it is better, even if you're selling highly appreciated stock, to sell that highly appreciated stock, pay the capital gain, then have the proceeds of the sale, even after the taxes, be used to do a Roth IRA conversion. I'm not going to tell you that's always going to work, but it will often work, particularly if you're in those sweet years between retirement and minimum required distribution. But what we're finding is we're still doing plenty of conversions for people who aren't in those sweet years. That is, they more likely are older than 73, so they have to take minimum required distributions. But a lot of times it makes sense to do Roth IRA conversions. And then part of the question is, well, what about Medicare Part B? And by the way, there is a large, we have a whole chapter on the impact of Medicare Part B in our book, Retire Secure for Professors and TIA participants, of which about 90% is relevant for all IRA and retirement plan owners. But I'm going to give you the short version. All right. And Steve Coleman, who's the ultimate number cruncher, I hope he's not listening because he would growl and hate this. But here is what I would say the condensed version of that. And it's very condensed and it doesn't apply to everybody or not even close. But if you do a Roth conversion, that's going to increase your income. And it's not only going to increase your income for traditional income taxes, but it's also going to increase your income for the purposes of what is your premium for Medicare Part B. So it might jump up your Medicare Part B premium. And let's say the Westinghouse folks who are very smart number crunching engineers, they would say, oh, gee, I don't want to increase my Medicare Part B. So they do a Roth conversion up to the point where they don't increase their Medicare Part B. And I'm not saying that that's all wrong, but what happens is if you do the Roth conversion, what happens is now you stop your minimum required distribution. So it often does pay in the long run, particularly if you have a long time horizon, and particularly if you're doing this for the next generation or even two generations, it often does pay. So don't think, oh, gee, it's a rule of thumb. I can't go into any increase for Medicare Part B. The right answer, I'm going to sound a little bit like a broken record, is to run the numbers. Why don't we take one more question and then we're going to move on.
Great. The next question is from an attendee in the live room. And they said, you mentioned how Roth conversions could impact your Medicare Part B premiums. I've never even thought about that. What are some other unintended consequences that can happen? Like basically, what are some other factors that you should be thinking about with Roth conversions?
I think there's a lot of factors. I'll tell you a bunch that people don't think about necessarily. One factor is, and I guess I'm stealing a little thunder from something that I'm going to be talking about later, is if you're married right now, you're in a much lower tax bracket than the survivor after the first death. So that's, let's say, in favor of Roth conversions, and hardly anybody takes that into consideration. Another factor is what state you live in and what state are you going to die in, or what state are you going to retire in. So a lot of our clients they're getting older, and even though they kind of assumed that they were going to live and die in Pennsylvania, a lot of them find that they are moving to where their children are moving. And guess what? Some of these ungrateful kids are moving into tax states that are unfavorable for their parents. So they're moving to New York or to California. From a tax perspective, that's horrendous because in Pennsylvania, you had to pay taxes on your IRA. But the good news was once you retired, or if you wanted to do a Roth conversion, they didn't tax that. So it was a bad place to work, but a good place to retire and not a bad place to die. Then they moved to California or New York. And so they didn't get a tax break going in, and then they have to pay the tax going out, and often at a high rate. Well, hey, if that's going to happen, do your Roth conversion before you move. So there's a lot of situations. And then the other question is, well, what about your beneficiaries? Are they in a high bracket? Are they in a low bracket? There's actually a lot of things to consider if you're going to do the calculation right. So I'm going to take a minute here to mention if you have heard enough, hey, I want to talk to these guys. We're going to do a little bit of a, let's say, a longer description of our services at the end of the webinar. But let's say you say, hey, I've heard enough. I want to talk to these guys. They really know what they're doing. They're working with first-class money managers, and I pay one fee, and I get great money management using low-cost enhanced index funds, and I get Lange's firm, who has these really smart number crunchers. I get some estate planning advice, and it's all for the same fee that Lange splits with the money manager. This is good. This is in. I'm in. So Justin, I'm going to ask you to put up a link for somebody who wants to, in effect, step in front of the line, assuming you qualify. And by the way, there is a reasonable chance you're not going to qualify. If I don't think I can save you a lot of money and your family a lot of money, um, that's not an attractive person for me to work with. And we're at the age and stage, and we have right now we are actually above capacity. I don't want to take on somebody unless I think I can really help them. We have a 97% retainage rate. You don't get that by not providing enormous value for somebody. So, in addition to not being an SOB and being pleasant to work with, we're more interested in working with people that we think we can help quite a bit. And if you are an SOB and you're difficult and you've gone to 4 advisors in 3 years and 2 CPAs and two estate attorneys, we don't need it. We really don't. So save us all some aggravation. Sometimes I don't pick up on that. If I do, we're just not a good fit. Life is short, and I'm at the age and stage. And even the people working for me they're all younger than I am, but they're not kids, and we just don't need bad work. And by the way, I should mention, it is not for drafting or wills or trust with our firm. We can refer you out, but that is not one of the offers that I am making. So before we go on, what I would like to do, since I've been doing all the talking and I am just, and I'm not the primary number cruncher, I'm not even close to the primary number crunchers in our firm. One guy, the super veteran Steve Coleman, he's been with me 30 some years. He is the ultimate number cruncher. As you would expect, his book is completely filled. He's not going to be taking new clients. But somebody who is, although her book is rapidly filling up, and I will just tell you, she is a wonder. She does, by the way, my big picture planning. I think she's wonderful. My wife loves her. She does all kinds of wonderful things. There was supposed to be an introduction that I was supposed to read about her, but I will just tell you that she is wonderful. And I'm going to skip the introduction. I will say this: she is a CPA, she's a CFP, she has a couple other. She's a CMA, which is actually a big thing. And I still can't read it because it's on the side. But anyway, I'll just say that she is one of the best combinations of, let's say, technically really good, but also a high EQ, meaning that she's very, very sensitive to people's needs, and she's very good at reading faces, and her data-driven approach and her compassion understanding is just wonderful. And she is here to say a few words. And by the way, potentially correct me. There was a question about the raises in uh, it, it was how inflation is raised. Maybe after you're done with your prepared talk, you can tell people why I was wrong. But anyway, here she is, Jen Hall.
Hi, everybody. How are you today? I'm Jen Hall, as Jim had said, and I'm just here to talk to you today about what our financial planning process looks like. Jim talks about our financial master plan, and I wanted to get into the weeds a little bit of what we do and how we do that. and how we work with you. So I don't know how many of you got a chance to hear Bert Malkiel's talk with Jim earlier in session 1. I thought his enthusiasm for the market and investing was truly inspiring and really enjoyed all the information he shared. So I'm hoping that I can share with you our deep commitment to our financial planning process and how excited we are about what we do. So we begin our approach. What is our financial planning approach? So we're CPAs. We're not attorneys. We're
Thank
not
God.
financial managers. We are your partner in the process to help you preserve your assets and pass on your legacy. So we try to work with you to align your values, your goals, your long-term vision to come up with this optimal plan that you're happy with. So we start with using your estate plan as the blueprint because that estate plan will tell us the who, what, how, and when of your estate and how you want to distribute your assets, who those assets are going to, when those assets are going to pass, and how they're going to pass. Are they going to pass outright? Are they going to pass through a trust? So we need to know that information, what's important to you, so that we're able to put that into the planning process. We use your estate plan as a financial GPS to help us map out the road for your financial plan and plan out different segments of the plan and how we should develop certain distribution strategies. So let's talk about distribution of your wealth. I think we can all agree that there's only 3 places your money can go. You can gift it, whether it be to your heirs or charity. You can spend it, or it can be left to Uncle Sam. So our goal is to make sure that the last one on that list gets the least amount. And we do that by developing tax strategies. And that's done part of your distribution process because there are various ways money can be distributed. One of the biggest questions a client will ask us is, okay, I'm retired now. I have all these different buckets of money. Where do I start spending them from? And we help you develop that distribution process by developing a pro forma of your tax returns starting from the current year that we start to work with you throughout your lifetime, because there are different pockets and windows of opportunity while you're working, before you're collecting Social Security, before your RMDs kick in. So we try to look at those opportunities where we can utilize different tools that we have to optimize your assets, minimize your income taxes, and allow your heirs to benefit from these strategies. Because you work so hard for your money, we want to preserve what is given over to Uncle Sam. That's our job. We're CPAs. We want to manage the tax piece, but it isn't just taxes that we manage. Our process is customized to you. It's not something where we have certain generic principles and everybody fits in that box. I can have 2 clients who have the exact same portfolio, but their goals are different. So their strategy will be different. Their distribution will be different. So it's up to us to work with you on how we can develop that strategy that will make sense for you and your family or your heirs, or if there aren't any heirs, how you want to distribute your money to your favorite charities, whether it be during your lifetime or during your legacy. So our plan is not static. It is constantly moving because we all know tax laws change, inflation rates change, family dynamics change, markets shift. Jim mentioned earlier, your children may move, so you may move too. So we have to develop a strategy based on all those various factors that are constantly changing. So it's not always going to be the same today as it may be a year from now or 10 years from now. So we do base everything on math. It's not something where we may pull an idea out that isn't math-based. We need to prove it to you on paper. And most of our clients, as Jim already mentioned, are pretty smart people. So they don't want to hear us say, well, we make this recommendation. They want to hear, show me the recommendation. I need to see it on paper. I need to take it home and study it and do my own calculation, and hopefully I'm going to come up with the same answer that you did. So we really don't use one strategy. We use multiple strategies. And I think one of the main questions people will ask us is, Jen, how much can I afford to spend? I don't know if I'm spending enough. I don't know if I'm spending too much. So that is an important aspect of our engagement, that we work with our clients to let them know how much they can afford to spend. Jim addressed and spoke about in his session 2 about the 4.7% rule of thumb that Bill Bengen wrote about. And that's a great starting place. And there's a lot of data and science that is backed behind that research and recommendation. So I think there's a lot of merit to what Bill Bengen writes about and what his research demonstrates. Our clients, because they are pretty quantitative, are interested in seeing their financial projections that we create by using their actual data of what they are currently spending, what they're spending their money on, documenting their specific spending patterns, and looking at their available assets. Because there are 3 different money buckets. You have your after-tax money bucket that has highly appreciated assets and low appreciated assets. You have your Roth IRA assets, and you have your pre-tax retirement assets. And if you spend down those monies in the wrong manner, it can be really costly to you. And not only costly to you, but costly to your heirs too. So we want to make sure that the recommendations we make to you are based on math and based on keeping your taxes to the least possible amount for what you spend. So when we do communicate our the amount of money that you can spend, we do communicate it in pure purchasing power. So while we may say to you, well, you can afford to spend $60,000 a year per year based on your current asset mix, well, when we make that recommendation, it's not just $60,000 in today's dollars. It is $60,000 in today's dollars every single year, reflecting pure purchasing power, because inflation is real. So we wouldn't be doing a good job, or we would be doing you a disservice if we didn't include the impact of inflation on our recommendations. So while we may give you a figure of what you can afford to spend, you may say, Jen, you just don't get it. I'm not going to spend that amount of money no matter what. It's not going to make me happier. So I appreciate it. But what they really do say, even though they may not want to spend that amount of money, and Jim will tell you he will always try to get his clients to spend more than they want to, knowing that number gives them such peace of mind, especially when you start out on your retirement journey. Knowing that number is something that allows you to put your head on your pillow at night and just give you a certain peace of mind. And that's part of our job, is to give you that peace of mind, because knowing what money bucket to spend from is a significant impact, has a significant impact to your overall financial plan. So our goal is to guide you in that spend down or draw down strategy. So it's about spending your money in a smart way that minimizes taxes, but also maximizes flexibility. So even things, questions will come up. What if I inherit an IRA? How much do I take a year? And do I distribute that the same amount every year? Do I change that amount every year? How many years do I have to distribute it? So the answers to those questions will impact how much you have left over to spend on that inherited IRA. So these are really good questions, and you want to work with somebody that is competent and qualified in this area and has dealt with this matter before. This is a case where experience does count, and we love working with you on these issues because it's an important part of your financial plan. I know Jim talks a lot about Roth conversions, and Roth conversions can be an incredible, powerful part of your estate plan, and financial plan. It actually can be a game changer if it's done right, but timing is everything. So how do we make those Roth conversion recommendations? Well, I think I mentioned earlier, we plan out what your income taxes will look like on a pro forma basis, maybe over 20 years, depending on when you come to see us, when you first come to see us. So while we may make Roth conversions, some people say, oh, well, I already missed that deadline. I'm already collecting Social Security. I'm already taking my RMD, so I'm really not eligible to do that. Well, that's not really true. There are 7 things that we manage when we're making Roth conversion recommendations. We're managing your marginal income tax bracket. We're managing your effective tax bracket, your IRMAA Medicare premium taxes, your net investment income tax bracket, your capital gains tax bracket. There are some people that may pay 0 capital gains taxes because of where their income falls, their taxable income. Now, with the new OBBBA Act that was just passed in 2025, we kind of had a little wrinkle thrown into it because some of the provisions of the bill are retroactive to 1/1/25. And one of those provisions was the introduction of the new senior tax deduction of $6,000 per individual. So we've actually had to go back and recalculate some of those recommendations based upon the new tax legislation. So that is an important component. And now we also have the new salt tax deduction limit. Instead of being 10,000, it's 40,000 in 2025 with a phase out. So that will also impact any Roth conversion recommendations we make. But like Jim said earlier, we're not making Roth conversion recommendations just to make a Roth conversion recommendation. You may not be a good person to recommend those for. If you're someone that is leaving 100% of your estate to charity, you may or may not be a good candidate, but you still may be a good candidate for Roth conversions because Roth conversions may help you during your lifetime for your taxable income. And if you're taking income that you don't necessarily need, why pay income taxes on it? So we do work with you to see what your long-term goals are, what your spending needs are, and how you want to convey your assets at your legacy. Another time to also consider Roth conversions is if you have two spouses and one spouse passes, well, now that remaining spouse will be a single filer the following year. So why not take advantage of that married filing jointly tax rates while they still have it available to them in the year of death? So we've worked with estate planning attorneys on this concept because some of them are aware that it is a good opportunity to make a Roth conversion and will recommend us to work with their clients on it. Another part of our engagement is a strategic gifting plan. Now, people ask, how can gifting be part of a strategic financial planning process? Well, it can, because smart planning matters. And whether you're gifting to your heirs or charity, we help you do it strategically. A lot of our clients like to gift to their children during their lifetime instead of leaving a gift legacy at their legacy, but the family dynamics will also play into when the parent may want to gift to their children. So we have to take that into account. Sometimes gifting is recommended because we're looking at reducing any inheritance tax exposure or estate tax exposure. If we're looking at gifting to charities, lifetime gifting may make more sense than legacy gifting, and doing so through qualified charitable distributions or doing so in a donor advised fund by using appreciated stock. We also may look at who gets what analysis. Do we want to, a perfect example is really leaving your IRA to the charity. But what about different children that you have in different income tax brackets? So you may want to leave your Roth IRA to your children who are in states who have a higher income tax rate, or children who are in an overall higher federal income tax rate than children who are in a lower income tax rate. Or if you have a child with a special need, they may need to have their income tax rates managed. So we have to take all of these variables into account when coming up with that optimal financial plan for you. So I want to give you one example of how we take multiple strategies to help our clients achieve their goals. So we can take a Roth conversion, couple it with a large donation to a donor advised fund, which will bring down the overall rate of the Roth conversion, the ordinary income tax rate. And this person, and we've done this and continue to do it for some of our clients who are charitably inclined, that they are able to see their charitable gift be realized during their lifetime, which gives them a certain satisfaction. And they're also able to help their overall financial plan by being able to do a larger Roth conversion, which can also be a form of a gift too, because you're taking the tax that's paid on the Roth conversion out of your estate, and you're allowing that asset to grow on a long-term basis, not only during your lifetime, but for 10 years past your lifetime when you pass to your children. So that is an incredible gift that you can give to your children. So there are various ways of gifting, and you can be very strategic in how you do it. And by doing it in a strategic manner, you're increasing your overall assets to your children or your heirs, but you're also increasing how much money you may be able to spend during your lifetime. So we'd like to align your values with smart planning. And that's why we also look at your estate plan, because we want to help you protect the money that is being passed to your heirs. Jim talks about all different types of asset protection. So we may recommend a trust if you have a spendthrift child. We may recommend a trust if you have a child who has a disability. So we want to make sure we preserve the assets for the child and not compromise any state or federal benefits. Jim talks about protecting your money from your no good son-in-law. So we may look at how we can make sure that we preserve your assets that are being passed on not only to your child, but to your grandchildren too. So the financial plan is about protecting your legacy, but also protecting your loved ones. And that is important to us. We are fiduciaries, so it's important to us to work with you so that you're happy with your plan, that you're given peace of mind, and you feel that you've done everything in your power to protect the family's war chest or be a good steward of the family money. And that is our job. Our big picture in this overall financial planning process is to help you enjoy your wealth, help you protect your legacy, but also minimize income taxes and estate taxes and inheritance taxes in the end, so that we're increasing the overall assets available. That's our mission. That's what's important to us. Jim talks about how he did this extensive planning on a Roth IRA, leaving for his daughter, Erica. And he planned this 30 years ago. And now this Roth IRA has grown to a 7-digit figure, which will help Erica during her lifetime, because the biggest concern for someone who has a child with a disability is, what will happen to them after I'm gone? Will there be enough money to help them live comfortably? And as a parent, we can all relate that that is something that is always on your mind. So if you can plan for this, and you can, then let's take that step to make that planning process be a true living thing for you and give you that peace of mind, because your estate plan is your compass. It's the blueprint. It's your GPS, as I said earlier. And we want to sit down with you and help learn about your values and learn how you want to pass on your assets and what's important to you, and protect your family and honor your legacy. And we're here to help you do that if you choose to work with us. So, in closing, we want you to enjoy your wealth, protect your legacy, and minimize your taxes.
Thank you, Jen. Thought you did a great job. And I'll tell you what my overall thinking is. I am such a lucky guy to have you and the other CPAs at the high level that you are. And you compare that to, let's say, a financial advisor, and they say, "Oh yeah, we have people on staff that does the same kind of planning." No, they don't. Not at Jen's level, not at Dom's level, not at Steve's level, and coming up, um, not at Mike's level. And it's just wonderful to hear that. And I realize what a lucky guy I am to have you and the team that I do working here. So Erica she's
Yeah.
going to hurry me along because
I'm trying to, no, I'm not hurrying you on, but I did want to flag you down. I wanted to ask, since we have Jen here, and that we have some highly technical questions that I think she would be great at addressing. Could we take a quick question break and she can address some of these?
Good. Give her the hardest, most technical question, the thing that you know that I'd go, oh no, or that I would give something that was be more general. So yeah, that would be fine. And I will return in several minutes.
So, Jen, I think before I get started, I do have several questions here that I think your expertise will be wonderful for. But Jim mentioned before that he had misstated and I had misstated. I think we were guessing as to what the basis that most people use when they're adjusting their safe withdrawal rate annually for indexing it for inflation. Can you talk about the number that
Sure.
people actually use for that?
Yes, Erica. So Bill Bengen bases the inflation adjustment on the consumer price um, CPI index and not the Social Security COLA. So what's the difference in that? It's about half a percentage point. So where the CPI index may be 3% inflation rate, the COLA for the Social Security may be 2.5%. So it's not a huge difference, but over a long term, if you have a 50-year path, that half a percentage point could make a big difference.
So that's really good information, and thank you for clarifying that. The first more technical question I have is from Scott. He says, I retired in 2025. My only income in 2026 will be restricted stock units, RSUs. Is the RSU income eligible to contribute to a Roth or a backdoor Roth account?
That the RSUs are not considered earned income, depending on how they're reporting it. It's usually their capital gains income. But my advice to you is if that is your only income and you're not having any ordinary income, I would look at ways to accelerate the income, whether it be through a Roth conversion, because we don't like to see you having 0% ordinary income because you're not able to take advantage of the 10% and 12% tax brackets. So if you do have some pre-tax retirement income, it would be advantageous for you to accelerate that income to use up some of those lower income tax brackets, especially if your long-term ordinary income tax bracket is projected to be in the 22 or 24% tax bracket. That could be an incredible opportunity for you. We don't like to see where sometimes we'll have clients come to us who are not paying any income tax, and we feel bad because there may have been some missed opportunities there.
You're muted, Erica.
Yes, thank you. One last question on some more technical issues. Wayne says, nearly all of my traditional IRA is in TSP, Thrift Savings Plan. Currently, the government doesn't allow a Roth conversion within a Thrift Savings Plan. Is there anything that I can do?
So you could look at, that's a great question. It's a question we've gotten before. So you could look at sectioning off a piece of that thrift savings plan and transferring it to an IRA and making the IRA, making the Roth conversion off the IRA. The problem with this sometimes, and we'd have to look at what the thrift savings plan rate of returns are. Sometimes they are yielding a higher rate of return that are people aren't willing to forego that rate of return because it's usually a fixed rate of return to be able to transfer it into the IRA and make a Roth conversion off of that.
And then I guess maybe one final question, Jim, you might want to come back on camera because this could be for both of you, I suppose. But Jim mentioned that we didn't cover a ton of specifics on the OBBB. But Jen has done a lot of work on this prior to this session. So I wanted to ask her, but also Jim, are there any elements of the OBBBA that you want to bring to people's attention, opportunities, pitfalls?
Well, I'll repeat that this is a wonderful opportunity to do additional Roth conversions at low rates and to enjoy the lower rates right now. So whether you agree with some of the long-term impact for the country or some of the impact that it has for Medicaid participants, which I think, and insurance premiums, um, you know, we we're attorneys. We thrive on the misery of others. It's not a nice way to put it, but it is an opportunity. And Jen will be more technical than I, but to me, it is a great opportunity for more Roth conversions, more low tax rates. And again, as Jen said, and I love the way she said, okay, we're going to look at this, we're going to look at that, and we're going to look at that, where I've been just kind of saying one thing at a time. And I think it's a really good thing for a lot of our clients, whether they agree with uh, whether it's the right thing for the country or not. Jen, you might want to weigh in on that.
Sure. So Jim hit the real high level of what the OBB Act comprised of. The biggest piece is the rates were made permanent, which means so up until July, we were telling our clients that this would be the final year of the lower income tax rates. Well, now we know that those rates are made permanent. So we know we're going to have those rates at least until 28. We don't know what will happen if newer administration comes in post 2028. I think we can all agree tax rates will not be going down, not with the rising deficit. But some smaller ticket items are that we're advising our clients. So all of those energy efficiency improvement tax credits are expiring at the end of this year. So if you're thinking about making any energy efficiency improvements, whether they be new windows, new doors, HVAC, insulation, do it before the end of the year. So it could give you up to $1,200 in a tax credit, not a deduction. And I'm not telling you to spend the money to get the tax credit. I'm only saying if you are thinking about doing it in January of 2026 versus December of 2025, we would encourage you to accelerate it into 2025. So some other provisions next year in 2026, the charitable contributions, if you itemize your deductions, are going to have a floor, which is new. This has never happened before, but now the first 0.5% of your adjusted gross income will not be able to be deducted. So for people that take the standard deduction, it's not a big deal, but those who are able to itemize and are giving some big charitable contributions know that it's going to be diluted beginning in 2026. Another item, and that's also a 2026 item, but for those people that are taking the standard deduction, now you'll be able to take up to $1,000 for a charitable deduction, even if you are taking the standard deduction in 2026, and up to $2,000 if you're married filing jointly. So if you're doing something in December versus January and you're not going to benefit anyway, then wait until January, because then you will benefit. You'll get that extra $2,000 if you're married filing jointly, or $1,000 if you're a single filer. So there's also the new automobile deduction for loan interest paid. It is for vehicles that were purchased in beginning in 2025, and it begins effective 1/1/25. It is for new vehicles, though. So used vehicles don't qualify, and there are some U.S. assembly requirements on those newer vehicles, so that they have to be assembled in the U.S. So if you are a candidate for that and you've already made that purchase, that is We're not sure what the new 1040 is going to look like yet. I think they're still formulating it. So we're not sure if it's an above the line deduction or below the line, and that will make a difference on your Medicare premiums. So I think that's a wait and see. But those are much smaller provisions than the big picture that Jim talked about earlier.
Jen, could I ask you a question?
Sure.
So I hate when people lose the benefit of a charitable deduction. Particularly these days, I think we have a lot of problems that the government isn't going to solve, and it's going to be up to local charities and even national charities to help with that. And I want everybody to get the maximum tax benefit. And now you're saying for people who are in high income tax brackets, they're going to be losing a lot of potential charitable deduction benefits. What about doing a big Roth IRA conversion and a big charitable deduction in 2025? And that way you get all the benefit of your charitable deduction, which is going to lower your income, which is going to lower the cost of your Roth conversion.
Jim, we're working with somebody on that as we speak. So that person that I talked about earlier, who is charitably inclined, interested in legacy lifetime giving, contributing to the donor advised fund and with appreciated stocks and making a large Roth conversion. That is exactly our recommendation, to do it in 2025, because next year that contribution will be diluted. Another thing, though, too, to take it into consideration, if you're somebody that's 70 and a half, don't give through your itemized deduction. Give through a qualified charitable distribution, because that's a way to not have your charitable contribution be diluted.
Thanks. I'll tell you what I'm thinking about, because we do talk about this kind of stuff, and you hear this, and sometimes we get together for group lunches or events or things like that. And then what tends to happen is the CPAs go off in nerd land and talk about a lot of this stuff and a lot of the clients and things like that. And then some of the support staff, they just kind of raise their eyebrows and they go off somewhere else because we're into it. And the CPAs here, they're not here randomly. Right now, it's very, very competitive to get seasoned CPAs who can do work at this level. And one of the competitive advantages that we have is that people with the mindset of Jen, who is a strategy person and who genuinely wants to cut people's taxes and help them, she is much more attracted to a place like ours rather than a place that is just cranking out either business returns or individual returns. One of our relatively recent hires was, well, now it's been years, but he was going to be a partner at a really good firm, but he didn't want to spend the rest of his life cranking out 1040s and 1120s business tax returns. He wanted to do the kind of stuff that Jen is talking about. And then even more recently, we hired somebody who was attracted to this kind of work. So it gives us a tremendous competitive advantage. That said, Jen, would you ever consider not doing any tax returns and just doing this high level work?
Well, that's a good question. I honestly believe that we have to do the tax return work to know how everything flows. There are so many different things that integrate, and if you don't know how these different pieces move in the tax return, and you don't know that until you're doing it. So that's why we do everything through a pro forma tax return. Because if we don't put it into the tax return, sometimes we could miss something. So you may understand the schematics, but if you're not actually doing it or preparing it, you can't see it. Sometimes I'll put different variables in and something comes out that I didn't think it would come out that way. And I'll have to look deeply into it, and then I see, wow, that's why I did it that way. And so our team of CPAs get together every Friday and we talk about the different concepts so that when another team member incurs a similar situation, they know how to answer it too. And maybe they'll have more foresight into it because they'll already be aware that it's happened. I think, too, one thing that's important is we do not want to be the historians of your tax information. We want to create that story. Anybody can do a tax return. It's the planning that gives value. That's where we shine, is the planning process. Um, yes, we prepare tax returns, but our favorite thing to do at the end is an actual versus plan. And that's kind of our report card. How well did we do when we planned out your strategy? Another thing I do want to note, and that came up, that thrift savings plan question came up. And what's new in 2026, and this wasn't stated earlier, is that you are able to do in-plan conversions. So this is something new. We haven't seen this come alive yet. So it's not something that's been out in the forefront for us. So thank you for bringing that question up to us. Because it is something that is newer. And thank you.
And for context, what that's kind of like is if you have your money in a 401k, you want to do a Roth conversion, you like the investments in the 401k, so you could have a Roth 401k. So I think that is analogous to the let's call it in-plan Roth conversion for the TSP. Is that fair?
Yes. Yes. Same concept.
And can I take a moment too? I feel like the topic that we're on here, we have a question from an attendee, and I think Jen, you've done an excellent job of talking about like a lot of the actual work that we do with our clients and the type of different analysis that we do and how we change analysis, for people whose fact patterns are maybe almost exactly identical in terms of the accounts they have and where the money is. But if their goals are different or if their errors are different, they could end up with two very different plans. But one thing that we have not covered, I don't think so far, but I think that really fits into this, an attendee from the live room said, "This seminar is great, but what's your business model? If I convert my IRA due to your analysis, what's in it for you? Is it a flat fee for you to run this analysis?" So if you could talk, either of you could talk a little bit about our flat fee for service analysis versus our master plans, or sorry, versus AUM.
Jen, do you want to do that one? I'm happy to do it, or I'll give it to you also.
Okay. Maybe you're best well suited for that question, Jim. I can add to it in terms of the process, but we do charge a fee. We don't do it for free. And I think Jim can go into more about what the fee is. The only thing I'd like to say is whatever fee we do charge, depending on the service, I know that whatever savings there are from a tax standpoint more than makes up for the fee that's charged.
Well, Jen is so ethical. She would not do a plan, nor would I, but she's probably in a better technical position to know that we can't get, and I would prefer not just save the amount of the fee, but save a multiple, preferably a large multiple of the fee for that kind of, let's call it fee for service type work. One of the problems that we have is right now we are at full capacity, and I think that all the CPAs agree that what they prefer, and this is partly their enjoyment and satisfaction, is having more, rather than a fee for service tends to be a transaction, and somebody does it once, or maybe they come back for review in a couple of years, And that's not nearly as satisfying as seeing people every year doing a review, and very frankly, a little bit of it is social, how's your family doing? And then sometimes you find out by even just chatting for a minute, oh, my daughter, who is doing great financially, is marrying a very nice guy, but he doesn't have any money. Oh, have you considered a prenuptial agreement? So we tend to prefer the classic asset under management model. Ours we think is much better, but I think that Jen, given a choice between a one-time transaction versus assets under management arrangement where we are doing a big chunk of work up front, and then we are meeting with clients at a minimum of once a year, is not only better for us, but it's also tends to be better for the clients. And we're not going to take an assets under management client unless we know that we can provide a lot of value. Is that fair, Jen?
Yes, Jim, it is. And one thing that we always stress when we are working with our assets under management clients and we are making Roth IRA conversion recommendations, we always say that we make the Roth IRA conversion recommendation in the year of conversion because things change. And we talked about that earlier with tax rates change, inflation rates change, rate of returns change. So that will impact family dynamics change. That will impact on the Roth recommendations that we make. So we like to make those recommendations on an annual basis instead of mapping out a plan, which we can do, but if things change, that plan may not be exactly the same as the recommendations that we made during that one-time engagement.
And then I'll take the second part of the question, which is how do we work in general, and how does our assets under management arrangement work, and why is it, in my opinion, and I think it's kind of obvious, and Jen, who is, let's say, she wants a lot of value for a client before she is willing to take somebody on. But I think our arrangement is the best arrangement for a client because let's say for discussion's sake that you were interested in assets under management and you found a good firm. You might have even found one of the firms that we work with that has, very good low cost enhanced index funds, that does the rebalancing, that does the asset allocation, that does the asset location, that looks at your estate plan, that does the tax loss harvesting and all that kind of thing. And for many people, that is well worth the 1% on the first million, and then it gets lower and lower percentages as the amount of assets under management go down. And that would be a great thing. And if you went to those folks first off, that would probably be really good. But instead, if you talk with us first, our arrangement is you get that same money manager doing the same high quality work, and they have assured us they work just as hard for, let's call it a partial fee than their full fee. And you get, not somebody like Jen, it might be Jen, it might be one of the other CPAs. You get this wonderful number crunching attorney who's really smart, is looking for all kinds of opportunities. We've emphasized Roth today, but there's a lot of opportunities. And above that, you get me looking at your estate plan. And I think that we just provide so much value. And in terms of how much we charge, we don't charge any more than the money manager charges by themselves. So how does that work? Let's just say for discussion's sake that there's a fee of, I don't know, say $15,000 or whatever it is. We get roughly 1/3 of that. Now, why do we get 1/3 when we might think that the value that we provide and the savings that we give is worth way more than 1/3 of the total value? And that is because while the value is great, it might not be as big a time commitment as actually managing money, which is labor intensive. And frankly, it's a different skill set, a skill set I never wanted to develop. I never wanted to develop the infrastructure. So that's the reason why the money manager gets a higher percent. We get a lower percent, but there's enough juice in there to make both of us at a much lower profit margin, but still a profit margin. But I actually think that the real beneficiary is you, because you're getting somebody like Jen or one of the other CPAs who are likely saving you a ton of money, and not just necessarily in taxes. Sometimes it's just smart planning, like protecting against a new spouse or a spendthrift or a situation at work or whatever it might be. You're getting all that value. You're getting a great money manager, and the total fee is 1% or less above $1 million. And so I genuinely think that that is the best deal around. Jen, you've been around a lot of places. Would you agree with that?
No, I agree. I think it's a great opportunity for our clients. I think our clients are surprised, pleasantly surprised about how manual our processes can be in terms of customization. It's not like we're plugging in a few variables and spitting out a plan. Um, it's very customizable to them. So, and they do get the best of both worlds. So,
Okay, I am looking at the time and we are close to done. In terms of time, I might go a few minutes over and talk about one or two more things. But Jen, thank you so much.
thank you.
This has been a wonderful opportunity for, frankly, our audience to hear more than just me. And being very frank, they will spend a bunch of time with me up front, but it will be you that they're going to be meeting with for the detailed planning and for the reviews year after year after year. And I think that you have done yourself very proud and our firm very proud. So I want to thank you
Thank
for
you.
coming on today.
Thank you. Bye, everybody. Have a good night.
All right, so I just want to cover one or two more techniques that we have not talked about. Um, One of the opportunities is to be able to separate after-tax dollars inside an IRA from the IRA in order to get true tax-free, the equivalent. Well, it's part of a Roth IRA without having to pay the tax. One of the sources is Internal Revenue Service 2014-54, which means that that money can be separated at retirement. Unfortunately, I'm not going to have sufficient time to cover some of the other techniques that we use that are a little bit more involved, but we've done quite a bit of it that we think is wonderful. A lot of people don't know that sometimes you can actually do a Roth conversion after you die. Well, obviously you don't do it, but you can plan for it. Limited circumstances, but we can arrange for the circumstances to work. And that works out really well if you're in a big bracket and your heirs are in a low bracket. And by the way, you can't do this with a traditional IRA. So you do have some hoops to go through, and I apologize for talking about sophisticated projects or concepts where I don't really have the time to properly go into it, but I can just say that for the right people, it can save a lot of money. And well, unfortunately, time is going to limit us. But the other technique that we sometimes recommend is it goes the other way, where we cash a portion of your IRA, pay the tax, get the after-tax money, gift it to a child, most likely, or a grandchild, and then have those dollars invested in something tax-free, like a 529 plan or life insurance, or for them to put money in their own Roth IRA, Roth 401k, Roth conversion. A very cool technique. I don't know any other firm that is doing that. Or, by the way, even better than Roth is a health savings account. There you get a deduction, it grows income tax free, and a distributed, assuming it is used for health purposes and medical costs. It comes out tax free. And by the way, during those years, you don't want to pay the medical costs out of that. I'd rather have that accumulate. Keep tabs on what you did spend for medical, and then in effect reimburse yourself. Very, very cool technique. And I actually like some of these things. And the taxable to tax-free is a wonderful technique. And it's a little bit like a Roth conversion where you're paying the tax, but the money is then goes to a child or grandchild. And unfortunately, I'm not going to have time to. I even anticipated I was going to be short. I didn't think I was going to be this short, but I'm not going to go through the case study where we really make a tremendous difference. And frankly, we're not going to take you on unless we think that we can. But the summary is over 2 generations, it can, using not terribly unusual assumptions, and comparing even just call it reasonable planning versus optimal, it can make a difference of $3.7 million measured in today's dollars. I just kind of, even though it came in the context of a question, I think I explained why I think that our model is so good for clients, because they're getting either Jen or one of the other CPAs to do this really high level work that are really smart people making amazing changes for somebody. We're taking a look at your estate plan. I personally am looking at your wills, trust, beneficiary designations of retirement plans. And you're getting all this for the same cost as one good money manager. So that's why I think that it is such a good arrangement. You don't have to be afraid that we are going to take you on as a client and not provide you way more value than your total fee, because we're at the age and stage we just don't need that. Another thing that Jen didn't mention is that we already have a host of people in waiting line for work for a fee for service type basis. So and since the CPAs prefer the relational value of assets under management, that is what we are concentrating on now. But I think that we just provide a great value. And if you are interested in potentially working with us, I'm going to ask Justin to pull up the let's say, I don't know if you do it in the Q&A or in the chat, but to pull up a place where people can say, hey, yeah, Jim, I am interested in a consultation with you and maybe Jen or maybe one of the other CPAs.